name is Innocent Nyakina Gisesa from the School of Engineering, Energy and the Built Environment from the Department of ENE, that is Energy and Environmental Engineering. And I'm going to take you through property investment appraisal, whose unit code is BEG3147. We have the course outline, which has been shown here, whereby on the first part of it, we are going to look on the meaning of what is an investment, and then we are going to look at the different types of investments we have, and then we are going to look at the investment objectives which different investors look for when they're investing in a given investment, and then we are going to look at the qualities required from an investment, and then we are going to compare real estate as an investment against other forms of investments we have in the market. And then we shall also be looking at the importance of investment appraisal. Then we are going to do a sample of various forms of valuation of the cash flows. And then on section 4, we are going to look at the relevant and irrelevant costs in regard to real estate investment. And then on the B side of it, we are going to look at the initial cost, that is the cost which has been used to undertake a given investment. And then we look at the incremental income, that is the income as it increases or changes in regard to years according to a given investment. And then we shall be looking at the terminal value. The terminal value is also refers to as the salvage value, that is at the end of the given time period of a given investment. And then under section 5, we are going to look at the methods of investment appraisal without risk consideration. This one, without risk consideration, that also refers to as the traditional methods of investment, because they do not take into account the time value of money, which is so essential in any investment. Remember, from the other unit we learned, money in hand is better than money which is not in hand, and this is in regard to the time value of money. Then under this, we are going to determine the initial cost and the incremental cash flows. Then we are going to look at the traditional methods of investment appraisal. Then we shall look at the discounted cash flows approach, and then we shall look at the discounted payback period and a modified IRR. This means the internal rate of return. And then we shall look at what we call the PI. The PI is the profitability index approach. And then we shall look at the annual worth approach. Under section 7, we are going to look at something which is very interesting. That is the investment appraisal and replacement cycle problems. Then in section 8, we shall look at the application of investment appraisal approaches to real estate development and the financing of construction and development projects. We have quite a number of selected references. There are many. I'm not going to read them, but you can be able to see from the ones which you have on this slide. There are already 7. And in the subsequent slide, we have another 8, in total making 15, which all those are very important for those who want to understand all these concepts in detail. So the question, we start from the first objective. Why do people invest? There are various reasons as to why do people invest. Remember, the basic explanation of an investment, this is the process or an action through which someone puts money in a given asset with an aim of making a profit. So some of the reasons which have been given here as to why people invest can include to improve their welfare. Remember, everyone needs to have a good way of living. So some of them, they invest in order to improve their welfare. Then there's to create wealth, both in current and in future. Some people can invest today like a small hotel, but in future they expect to be having a chain of hotels. Then, of course, this one is all about creation of wealth, maximizing wealth, assumed as the overall. The basic aim of any investment is to create wealth and then maximize the wealth. So other objectives, there are many, but this is just a number of those objectives which have been mentioned here. So when someone mentions this one, don't presume or assume these are the only objectives. So there's the maximization of sales, Remember, like the marketing and selling, they want to make more sales. You want to outcompete you want to outcompete your competitor, and then there's a satisfactory level of profit. If someone gives you a profit of 10% and someone gives you a profit of 20%, which profit will you take? It's normal common sense. You'll take 20 and not the 10%. And then there's the survival of the farms. Every farm wants to remain afloat. There's no farm that, there's no one who wants to open a farm today. Maybe in the next like 2 years, the farm is not operational. Someone wants to open a farm today and the farm will be operational up to a period of more than 5 years. Then we have creating employment. We want to employ as many people as possible and maintain their jobs while giving them proper working condition. Then there's the minimizing the level of employee turnover. Turnover of employee, this refers to a situation whereby today you have employed an employee, but tomorrow is looking for another job. So everyone in a good organization or in a good firm, someone should be able to work for at least 5 years. But if you get a situation whereby someone is working for your firm for 1 year, maybe all for 2 years, and now they do not even want to work on the 3rd year, they want even to go at home, that is not a good implication of your firm, or that is not a good image for your firm. So there's also maximizing the managerial salaries. These are the managers whom you have entrusted with the running of the firm. And then there's protecting their wealth. Remember, if you have invested like 10 million in a given investment, you don't want to lose the 10 million. You want the 10 million to make an additional, maybe 2 million, 3 million, or 4 million. But you don't want your 10 million, maybe after 1 or 2 years, you're getting 8 or 7 million. And of course, there is a protection of your wealth from inflation and taxes. Then investment. This is now according to the Real Estate International definition of investment from RICS. RICS is our international body. So an investment may be defined as the purchase of a financial or real estate asset that produces a return proportional to the risk assumed over a long period of time. What is risk? Risk is the uncertainty. You don't know what will happen tomorrow. You don't know if you have invested 10 million, how much you're likely to gain over a given period of time. So an investor, every investment you're making, it has the return you expect, it has to be proportional to the risk you are prepared to undertake. The time period should be a minimum of 3 years. A good investment should have a minimum of a time frame of 3 years up to 10 years horizon. But if it surpasses 10 years, that means the investment is extremely good. So we are going to break down this investment. We have return, which you have already talked up there, because an investment you're aiming at making a return. Then we have the risk and the time period, which I've talked. What is return? Return represents the total annual income and capital gain as a percentage of investment, while risk assumed should be proportional to the expected return. What is the time period? The time period, this is the time frame which you expect to be holding a given investment while making profits at the same time. So the investor must determine whether given investment is long-term. Is it for 20 years? Is it for 30 years? He has to determine whether it's for short-term. Short-term, it has to be 3 years, 5, or 6 also, and so. Or is it an intermediate term? This is not short-term, it is not long-term. So what is the cut line between investment and finance? Most people do not understand what is the difference between investment and finance. But to make it simpler, an investment, if you want to start a factory, that is an investment. But now where you get the funds so that you can be able to start up the factory and make the factory running, that is now where finance comes in. Building a factory is an investment. Where you obtain the required funds to undertake the investment is an issue of finance. And normally finance, this now goes to the accountants who determine how you raise the finances and how you run your factory. What is the difference between investment and speculation? What is speculation? Most people can speculate like that today evening it's going to rain. That's a speculation. But in investment, you cannot tell what can happen in a long period of like 5 years. That's why if I was to borrow from climatology, that's why now the difference of weather and climate comes in. Weather is more of like speculation, while climate is more of like an investment. So the difference between investment and speculation is primarily in 3 differences. The amount of return expected. What is the return you are expecting from a given investment? What is the amount of risk are you prepared to undertake in order to take that investment? And what is the length of holding period? Speculation is for short periods of time, say from 1 week to a few months. But for investment is for a long period of time. Like in the Kenyan market, you always buy after you have bought something. Let's say you have bought like a block of apartments or a commercial block of offices. After you have bought it, you want to hold it for some time so that you can be able to regain back the initial cost which you used in buying that block of apartments. And then most people always will pray. You pray for the good things to happen. You don't want anything bad to happen to your investment, and then you will sell it after a given period of time. That is if you have been satisfied with your investment. The Kenyan way, that is normal the Kenyan way. An investment is continuous for a longer period of time and is managed. Remember, there is no investment which is not managed. But a speculation, you don't manage it. If you have a block of apartment, you need to have the property managers, you need to have cleaners, you need maybe even you need to have the marketing and sales so that you can be able to alert the market that maybe some apartment or some office is vacant so that they can be able to rent it. The emphasis in speculation, because of the shorter holding period, is on the capital gains. That is speculation. The emphasis is on capital gains or appreciation rather than dividend or interest income for as it is in the investment case. These are further definitions of investment. In finance, different people define investment in different ways. Remember, as real estate is how I've defined it in the previous slide. But now in finance, they have their own definition. When you go to the business field, they have their own definition of how they define finance. In finance is the purchase of a financial product or other item of value with an expectation of favorable future returns. In general terms, investment means the use of money. It's the use of money. Remember, finance, it's all about money. So they are more concentrated with the using of this money, which are investing in a given investment with the hope of making more money. So in finance, it's all about making more money. Remember, some people invest not because they want to make money. Some people invest just because they have the wealth. They want to show it off. They want to show that they are the who and who in society. Some people invest not because they want to make any profit, just because they want to employ people in the society. So there's a second definition here in business. In business is the purchase by a product of a tangible asset. Remember, tangible asset, this is something which you can touch, such as a real property. Real property, remember, real property, this has already been defined in a lot of ways. This is the interest someone has. These are registrable interests someone has in given properties such as land, buildings. Then we have the factories. Factories, they act as producing agents, a service providing outfit, equipment, etc. in expectation of future cash flows or benefit. The one which, the definition which is down here, investment consists of initial investment. This initial investment, this is the initial amount of money you put into that given investment. The working capital, this is the amount of money which you use in the day-to-day, month-to-month running of that business. And subsequent addition. Remember, as an investment, sometimes you need to add something because the market is not rigid. The market keeps on changing. So there is these are what you call inventories, what you add on to the initial investment, and equipment which will be necessary for an operational and profitable enterprise. You can start an investment. When you are starting an investment, in the initial stages, you get like you're using 1 car. But after like 2 years, you need like 2 cars. After 4 years, you need like 5 cars, and you might even need 5 printers, and even you might be needing more office space. So return represents the total annual income and capital gain as a percentage of investment. We have already defined this. So what is the return and risk and the time factor? Investors should attempt to keep the risk associated with the return proportional. Remember, when the higher the return, the higher the risk you are ready to undertake does not necessarily commensurate to a higher return. You have to keep it proportional. You know, some people can say, if I invest 10 million, then I expect maybe to make an extra 5 million. That is not normally the case, because the world is not constant. It keeps on changing. Note that seeking excessive risk does not ensure excessive return, and that not all securities that are given the same level of return have the same degree of risk. Let me explain this. You might get in a given investment, like in insurance. Someone has got an insurance company here in Thika, and someone has got an insurance company somewhere in Nairobi. You expect of course, someone who has an insurance company in Nairobi, it's more risky because he's investing more. So you expect, because he's ready to undertake more risk in Nairobi, his return or a return will be more. That is normally not the case. You might get the person here in Thika who has an insurance whose risk is less compared to the risk someone undertaking, or who is having an insurance company in Nairobi. This one in Thika is making more than the other individual. Then, of course, the time factor. How long do you expect to be holding this investment? The time period is an important part of the definition of investment. The investor must define the life of one investment. When someone constructs something, there's that time period. You look, you want to use that period for all the car you have. So we go to a word for investors. Investors are risk averse. Risk averse, there's no investor who wants to take or who wants to go a loss. And as much as they're risk averse, every investor wants to try and minimize the risk as much as possible. So investors are likely to prefer an investment with the highest return but with the lowest risk. Investors are likely to prefer an investment that offers the highest return with the lowest risk. That is an investment that offers the lowest risk, commensurating with any given level of return. The higher the return, the higher the risk. If investors expect higher return, they must accept a higher level of risk. So we go to this to another point. Investors try to maximize returns and wealth. Every investor wants to make a lot of returns and a lot of wealth. At the same time, they want to minimize the risk which they are going to undergo in any given investment. What is involved in the investment process? Basically, there are only 6 factors that are involved in an investment process, and they have been defined here. Unavailability of funds. Do you have the funds? You might want to start a factory, but what is the amount of funds do you have? What is the size of the factory that you can start? You might be wanting to start a bakery or a vehicle manufacturing company, but the funds you have cannot accommodate a vehicle manufacturing company. So you have to look maybe for more funds or for other investment which would be able to accommodate the amount of money you have. Then there's a determination of the risk involved. What are the risks? There are many risks that an investment undergoes. There are calamities, like the calamity we're having currently, the epidemic, like the coronavirus. And of course, there are other like fire, there might be floods. You have to look at all those risks. There's the risk of hooliganism. There's, of course, the risk of vandalism. And then there's the knowledge of investment of alternatives. How many alternatives? Instead of investing maybe in production of motor vehicles, you can invest in production of maybe bread. Instead of investing maybe of industrial equipment, you can invest maybe in a production of maybe even blankets. You have to look at all the alternatives you have and which alternative will give you the highest return at the lowest risk possible. And then the method of analysis and selection. Which method are you going to use to analyze this alternative? And once you have chosen a particular method of analysis and selection, can someone depend on it? Is it scientific and can it be depended on by someone else? And then how does the stock market work? The stock market, like the stock market exchange in Nairobi, you need to understand how it works in regard to your investment. Remember, different investment have different regulations which are given by the government before you can be able to invest in them. Then knowledge of the fundamentals of portfolio management and ability to put them to work. What is a portfolio? A management portfolio, this is when you invest in different production lines. Like some people might be investing in transport, while at the same time they are investing in milk production. Types of investment. We have two types of investment. That is the real estate investment, and then there is the financial assets investment. Those are the only two investments we have. Under them, we have what you call direct investing and indirect investing. In direct investing, we have the non-marketable. Then we have the money market. Then we have the capital market. And then we have the derivatives market options and future contracts. Under the non-marketable, we have two. That is the savings deposits. These are done in the banks. And then there's the certificates of deposits, which have, once you deposit, you are given a certificate. Like when you go to the bank, you deposit, let me say something like 100,000. Of course, you are given a receipt showing that you have deposited this amount, you deposited that it at which branch, at what time, and so on and so on. Then there's the money market. Under the money market, we have the treasury bills. We have the negotiable certificates of deposit. Then we have the commercial paper. Then we have the capital market. Under the capital market, this is so crucial, and it will be discussed later in detail. We have the fixed income. Then we have the treasury bills, the corporate and municipal bonds. We have the equities. We have the common stock. We have the preferred stock. Under the derivatives market, we have the options and future contract. Then there's the indirect investment, investing. This is done by companies, unit investment trust, you know the trust, and money market mutual funds. Investment qualities. There are many qualities and different qualities which investors are looking for in a given investment. So we have return is the main thing in investing. Everyone wants to make something out of it. But after return, there are other factors, which are so many. I've said some people invest because they want to show off they have the money. Some people invest because they want to employ. Some people invest for various reasons. Some of them is the security of capital. The money you have invested, is the money secured? Can you be able to recoup it back after a given period of time? Then there's the capital growth. If you invested 10 million, can that capital grow from that 10 million to 15 million over a given period of time? Then there's the income security. Income security. If like in the first year you're making 2 million, in the second year, are you going to make another 2 million, or you are going to make 100,000? So there's that security, which needs to be predictable. So a good investment, remember, this income security, you want, like, if the first year you are making 2, the second year you can be able to make another 2, or you can make 3, or you can make something additional. Then we have the income growth, whether the income is secured from inflation, and whether the income can grow in real times. Then there is the tax treatment. Then there's the life of the investment, and then there is the ease and cost of transfer. This, the last, you are going to look at them in detail. The attributes of a perfect investment require that the capital invested is secure. I've already talked about this. You have 10 million, you don't want to lose it. Increases in real value over time. You have 10 million, you want to go to 15 million, and is hedged. Hedged actually means it's prevented against inflation. Because again, inflation affects the value of a given investment. So some of them, the investment is easily and speedily tradable, can be sold without restriction and with low transaction costs. There is ample demand for that investment, that the investment require minimal management. Remember, management comes with a cost, and it comes with a lot of experience that is needed. Where possible, there is little or no government interference. This is not always true. And this will never be true, because there is always government interference in any management that is undertaken. But it is given, like you assume, like your investment is functioning in a vacuum. It's homogeneous. It's the same. It can be broken into equal and similar parts and divisible in small lots of reasonable cost. Real estate ranks low among the perfect investment. Remember, when you are looking at all these things, a good any real estate investment cannot be able to meet them. But still, it doesn't meet suitors, people who are ready to invest in real estate. So real estate covers a diverse range of properties having differing returns. If you want to deal with income only, you have to do what you call mortgage, like the mortgage loans which are being given by the banks. If you want to do with what you call capital appreciation, this is where you buy land, let it lie for some time. You buy land for like 2 million, you let it lie for like 5 years, you come back, you get the value of land is like 7 million. That is holding undeveloped land. That's a vacant piece of land. But for income and capital gains, here you are making income continuous and still the value keeps on improving. This is like holding a block of apartments or a block of offices. If you have a block of apartments, let's say there are 20 blocks, and there are 20 apartments in a given block, and each one of them is maybe giving you 20,000. At the end of the month, you're making like 400,000 from that block of apartments. But if you bought it, let me say like 2020, by 2030, in 2020 you might have bought it like maybe 20 million. In 2030, the value, the capital gain will have gone high, and you might getting your block of apartment going for something like 40 million. So we have advantages of real estate as an investment. There are many of them. But the sum which have been listed here is income. When you have real estate as an investment, you are assured of gaining your income. You have your block of offices. At the end of the month, maybe office A1 is going to give you maybe 10,000. Office B3 is going to give you 20,000. So you are assured of earning an income from holding a real estate investment. Appreciation, it will keep on adding in value as time goes by. Remember, the market is changing. When someone was buying maybe a piece of land in let me say in 2005, he might have bought it for around something like maybe 500,000. But if that person was to sell that piece of land today, he'll be doing something more than maybe 3 million, depending on where that piece of land was bought. Then there are tax advantages on the interest on mortgages, depreciation for leasehold, real estate, and rent treated as a cost to the tenant. Then there are other advantages. You can be able to use your real estate as a collateral. You can be able to, a collateral, you use it as security to obtain a loan, maybe from a bank, maybe from a SACCO, maybe from someone. So that is what collateral is. Then there's that pride of ownership. You have your real estate. You're so happy. That is my block of apartment. That is my block of offices. There's that pride you always have associated with owning real estate. And the fact that real estate cannot be lost. Remember, you cannot lose real estate, or you cannot misplace it. Like when you live here, you go back to your homes. You know where your home is. Your parent, when he acquired that piece of land, he knows where it is. Even if he was to move out of this country and maybe go to another country and come after 10 years, if he will always remember my piece of land is here and was here. So it cannot be lost, all misplaced. And then it gives the owner a sense of security But like if you have a problem, you can be able to sell that piece of land and be able to solve your problem. Then there is that is what you call the sense of security and emotional support. Remember, something which has gotten advantages must also have disadvantages. Just like real estate, it also has disadvantages. Liquidity. It's not easy to transfer the ownership of real estate from one person to another. So there's always that element of time which is involved in the liquidity, and it is always fixed to given locations. Like it's hard for someone like me maybe to go and buy a piece of land in some places like, let me say Mandera. I've never gone to Mandera, but it's easy for me maybe to buy a piece of land in Thika because I've been to Thika. Then of course it requires management. There is the aspect of cleaning, there is the aspect of maintaining maybe the lighting, there is the aspect of maintaining the floors and the walls. And this one comes with a cost, and it has to be done on a regularly basis. And then there's the property hazards, something which I've already talked about, which include fire, flood, vandalism, riots, which will always happen whenever there's a political turmoil. Then there's legislation. Legislation, this is the right in real estate, have been subjected to state police powers protecting use, safety, health, environment, rent control, and state sovereignty than any other investment. There are a lot of legislation which are involved in regard to the ownership of real estate. And then there's a registration of real estate ownership. Once registered, land and property ownership is in public knowledge. Remember, if you know someone owns a given property, and that individual comes to you and takes a loan, and then defaults in the payment of that loan, you can be able to take them to court and maybe hold on to that piece of land for it to be sold so that you can be able to be paid back your loan. That's another disadvantage which always happens in the market from time to time. Investment appraisal. Principles and techniques. What is an investment appraisal? An investment appraisal, this is an analysis of a given investment. Economics is the science of allocating scarce resources. Resources are very scarce, and they have competing uses between alternative uses in order to obtain the best alternatives. Investment appraisal is a special area of microeconomics and concentrates on evaluating intended allocations and expenditure of resources among competing alternative projects so as to produce the highest benefit for the risk assumed over the longest period of time. So, investment appraisal assists the management of an organization to decide whether or not to make an investment, whether or not an investment is worth undertaking, and helps in the choice between two alternatives. That is the point. Remember, you are always faced with many alternatives. You have to make the choices. That is now where investment appraisal comes in. An investment has the following basic features: potentially large and anticipated benefits compared to other initial expenditures, a relatively high degree of risk as it concerns the future, and the time lapse between the initial outlay and the anticipated returns. Role of investment appraisal, even from the definition, which has been self-explanatory. The first role is to make the right choice of what to invest in from competing alternative. And of course there is, after you have made the right choices of what to invest in, then is it worth to make that investment? And how long are you going to hold that investment? But I've broken down them here. It gives managers information needed to make a sound decision. It allows approving authorities to make decisions knowing that they are underpinned by robust analysis. You don't want to invest in something, you do a very large capital outlay, then after some time you come to regret of having made an investment in that given investment. Records that the project is expected to achieve, what do you expect to achieve from a given investment, and the factors on which the decision was based on. Which criteria, which analysis did you use in arriving at a given investment? The aim here, the aim is to place decision making on a structured, the aim is to base decision making on a structured, rational, and informed basis with a clear understanding of the costs, and the benefits of the available options. I repeat, the aim is to place decision making on a structured, rational, and informed basis with a clear understanding of the costs and the benefits of the available options. Full stop. The appraisal is also important for any later review or audit, because you always want to audit whether the decision you made in regard to a given investment was based on sound mind or not. So the investment appraisal decision seeks to provide a body of analysis giving answers to the following question. There are quite a number of questions. These are some of the questions. Should the investment be purchased? What specific investment should a firm accept? How much of capital expenditure should the firm undertake? How long should it be held? This is the time period. What are the tax implications of owning the investment? How risky is the investment compared to others in the market? And what does the investor do to balance the risk with the returns available in the investment market? Why the importance of better investment? Why is it so crucial to make a good investment? There's the efficient use of limited resources. We have said the resources are scarce. So you want to use the resources in a proper and good way. The increasing initial cost and operational cost of the enterprise. Then increasing complexity with the globalization of enterprises. The world is always changing, I've already said that. Then there is the tightening of competition. There are many people who are competing against your firm. So you need to make those right decisions so that your competitors do not overdo you. Then there's the profit margins. You want to make a lot of cash, obtainable at becoming smaller. Then risk and capital investment decisions. This table here is crucial. The risk in capital investment decision. There's what you call the capital budgeting. You analyzing alternative long-term investment and deciding which assets to acquire, eliminate, and renovate. Which assets do you need to acquire? You don't have them, so you need to obtain them. Which ones do you have, but you want to do away with them because you're making a lot of losses by having them? And then, amongst the ones you have, which one do you need to improve? That is what you need. That is why you need to renovate them. So yeah, the outcome of an investment, remember, it's uncertain. You can't tell. Investment involves a long-term commitment. That is a minimum of 3 years to 10 years. Then decision may be difficult. I've said it may, but normally it's very difficult or impossible to reverse. Once you have built a block of apartments, at a given stage, it might be very hard to reverse that decision because of the amount of money you invested at the beginning. Then large amounts of money are usually involved. Then steps in project implementation. There are again 6 steps which are very crucial in project implementation. Step number 1, you need to understand the problem and the goal. You have a project. What is the problem you have? What is your goal? Your problem might be to provide education, like our institution, MKU. What is the goal? The problem is maybe education. So what, after providing the education, what is your goal? Of course, you want to provide quality education. Then number 2, you have to gather the relevant information. Before starting like this learning institution, you have to gather relevant information from other institutions which have already been in the market and how they have been faring on over a given period of time. That is what you call historical cost and other information. Then make prediction. You can be able to make predictions from your own. Like how many learning institutions do you have here in Thika? How are they going to compete with the learning institution you want to start? And define the alternative solution. Which other things how can you do it better from what the available learning institution have done, so that yours will be having a cutting competition edge against them. Then evaluate each alternative. Evaluate each alternative and select the best alternative using some criteria. You might get like the learning institution we have. Some of them might not be having the swimming pools. That might be one thing you might be looking at. Some of them might not be having maybe the gym, the gymnasium. Then you have to implement the decision. After you have satisfied all these 4 steps, now you go to implement. Now implementing might be like building the institution, acquiring the relevant regulations, then employing the lecturers, employing the supporting staff, and so and so. Then after you have implemented the project, or after a given period of time, you can say like after 5 years, you now evaluate the performance. What you're expecting from the beginning here. Have you been able to achieve it? How you have not been able to achieve it? Information needs. The following information is needed to evaluate investment using the time concepts. We have already looked at this in the other slides. So types of business expenditures. There are basically 4 types of business expenditures. We have the operating costs, which are also called the annual cost. We have the maintenance cost, like the building they need to be maintained, the investment commitment, and of course there's the research and development for the students and for the staff. So the data requirement, identify relevant and irrelevant cost. What is the difference between a cash flow and an accounting profit? 2 alternative criteria available to quantify future benefit accruing from an investment appraisal. There's the accounting profit and the cash flow. What is the basic difference between the two? The basic difference between the two is the inclusion of certain cash expenses in the profit and loss account. This is the business we did in high school. For instance, depreciation. Depreciation is involved in the accounting profit, but it is not involved in the cash flows. You can be able to see it in our subsequent table, whereby in an accounting approach you can see the revenues. It's 1,000, the cash expenses, then we have depreciation, then we have the earnings before tax, then you have the taxes and the net earnings. So depreciation is not a cash expense, so you do not include it in a cash flow approach, but you include it in an accounting approach. So from earnings to cash flow, from your earnings to the cash flow. Earnings can be manipulated by the accounting entries. Remember, the books of accounts have always been manipulated. If you go to a petrol station, you want to buy it, they will manipulate it to show you how good the petrol station has been functioning. In real essence, that petrol station has been functioning very poorly. This could mean that 2 firms with identical businesses, like 2 hotels, which are very adjacent, therefore, people prefer to use the free cash flows instead of earnings, because earnings most of the time they are manipulated. Valuation is about the future net spendable cash that the investor will get from owning the income. At the end of the day, cash is the king, but the earnings are not the king. Why cash flows? Why do we use cash flows? The basic reasons as to why we use cash flow, you can be able to discount and be able to predict the future performance of the firm over a given long period of time. They measure the actual economic wealth. They occur at identifiable time profits. Like they can occur at the beginning of a given time, or they can occur at the end of a given time. They have identifiable direction flow. They are free of accounting definition problems. The meaning of relevant cash flows and irrelevant cash flows. Relevant cash flows, these are cash flows which are directly related to a given project. Irrelevant cash flows, these are cash flows which are not directly related to a given project. I'll give you an example here. There's an example which is ahead, but first, before we go to the example, we need to understand cash flows and depreciation. Always a problem. Depreciation is not a cash flow. Remember, depreciation is the wear and tear over the long usage of a given material or equipment over time. Depreciation is simply an accounting amortization of an initial capital cost. Depreciation amounts are only accounting journal entries. Depreciation, when considered as a tax deduction, results in less taxes and is therefore a source of cash flow. There is a very long example here. A property management firm, I want to read it word by word. A property management firm is considering the purchase and installation of a lift in one of its in one of its 100 million worth rented building at a cost of 3 million. 6% of the lift cost will be borrowed and repayable in 3 years at 20% interest per annum. The lift is expected to have an economic life of 5 years. After the installation of the lift, the building will be more attractive to the prospective tenants, and the rent is likely to rise to 9 million per annum. It's likely to rise from 9 million per annum to 10 million per annum for the expected 5 years. That is the economic life of the lift. The operational costs are expected to increase by 10,000 per month. So what are the relevant cash flows here? The relevant, there's the 1 million in incremental rent per annum for 5 years. Remember, initially, this building was earning 9 million. After you have installed the lift, it increases to 10. So there's 1 million incremental, that is a relevant cash flow. And then there's the additional operational cost. The operational cost is expected to increase 10,000 per month. So per month there's an additional 10,000. If you do times 12, so per annum is going to be 120,000. Then the decision whether to install the lift could not be affected by the current value of the premises. You don't care about that. It's not directly related to the project. The current income from the premises, the financing of the project, and the consequent payments of the principal and interest. Note that the relevant costs are therefore future incremental cash flow from a given project. Other cash flow issues, the other cash flow issues have already been listed here. There is the tax payable. If the project changes the tax liability, those change tax are a flow of the project. You have to analyze them. Then there is the investment allowance. Are you given any allowance by the government after you have invested? Is it attractive to do that project? Then, of course, there is the financing flows. Investment appraisal is about the firm. Interest paid on debt and dividends paid on equity are the components of the cash flow. How much are you expecting to gain after investing in a given investment? So this is a further explanation of the difference between the relevant and the irrelevant cash flow, which I've already defined. Now I want us to look at the difference between hard and soft cost. The basic the components of our analysis, the following 5 elements should be considered while evaluating an investment. The initial amount to be expended on the investment, the potential benefits in the net operating cash flows, then there's the time period of the benefit, that is the time frame, and then any final recovery, that is the terminal value or the salvage value, and then the terminal or salvage, and then there's the discount rate. That is the rate like 10%, 12%, which is normally used. And this discount rate has got an aspect of inflation factored in it. Any proper economic analysis must take the 5 factors into account to judge whether the investment is worth to undertake or not. Determination of the initial investment cash flows. What it determines, basically, without going through each and every of this, what you determine the initial investment cash flow, that is what you are investing in. If you are investing in something which is very big, all that requires a lot of input, a lot of manpower. Of course, you'll have to use more initial cost. So what is the difference between hard cost and soft cost? The basic explanation or the cut line between the hard cost and the soft cost is that the soft cost, these are paid for to the professionals, while the hard cost, this is what you can see. The hard cost include the land cost, the site preparation cost, each excavation, utilities and installation, then the shell cost of existing structure in real project, the permits, contractor fees, construction management and overhead cost, materials, labor, equipment, rental and tenant finish. The soft cost, there are many. Loan fees, we have the loan fees, we have the construction loan interest, we have the legal fees, we have the soil testing, environmental studies, land planner fees, architectural fees, coin surveyors fees, engineering fees, the marketing costs, incurring advertisement fees, and then the leasing of sales commission and the development fees. Then you go to the net operating cash inflows. This is the net changes in revenues and expenses directly arising from a given investment. After adjusting for income tax, these incremental changes include such elements as operating savings from a machine replacement, additional profit from a new product line, increased profits from a plant expansion, and increased working capital. Then evaluating cash flow estimate, the question that require answers: are income and expense figures used in appraisal consistent with those of comparable properties in the market? Are anticipated future income and expense figure realistic and grounded in the market research? Are the anticipated future income and expenses figures consistent with the leases currently in place? All this is just theory, but it basically involves analyzing how much a given investment is going to give you over a given period of time. And that is all I had prepared for this lesson. And that marks the end of it. And I thank you for the time which has been presented to you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.